Hello, everyone, and welcome. My name is Amanda Waddell, and I'm the training manager here at BVR. Our webinar today is Cost of Capital Professional, straightforward, credible, cost-effective. Before we begin, I'd like to remind you that your attendance today is eligible for 2 CPE credits. To receive the credit, you must answer 6 poll questions that will appear during this webinar, and you must complete and submit a brief survey within 5 business days. A link to that survey is included with your login email. It's also available on the event page for the program. At the conclusion of today's program, you will automatically be directed to that survey. If you're registered as an additional listener, you must be on your own device so that you can respond to the questions and qualify for CPE. If during this webinar you have any trouble with the audio streaming, please try refreshing your screen to fix that issue. We'll take all questions for our presenters using the Q&A chat function on the side of your screen. Again, to receive your CE credit for today's webinar, you must answer 6 questions that will appear at random times during this presentation. Now I'd like to introduce today's speakers. Dr. Michael Crane is both an academic and practitioner. He's a professor and director of Florida Atlantic University's Center for Forensic Accounting and has been a licensed CPA and practitioner for over 30 years, with several certifications in valuation. Dr. Crane is a past chairman of the AICPA's Business Valuation Committee and has been inducted into the AICPA Business Valuation Hall of Fame, among many other awards and accolades. Ron Senior is the current chair of the ASA's Business Valuation Committee and managing partner of Senior Gustafson LLP, based in Colorado. He's a frequent speaker and author on professional practice issues, including leadership, cannabis industry matters, strategic planning, compensation, and related topics. Adam Manson is the Director of Valuation Data here at BVR. He oversees various data products and has led the development of various platforms and tools, including DealStats, Cost of Capital Professional, and the Guideline Public Company Comps tool, among others. Adam has been with BVR for 16 years and holds an MBA from Portland State University. Full bios for our guests can be found on the webinar presentation page as well. And with that, I'll turn this over to our speakers. Have a great presentation.
Thank you, Amanda. We appreciate that introduction, and we appreciate everybody taking the time to be with us for the next 100 minutes or so. As you can see on our title page, it indicates straightforward, credible, and cost-effective. Those are 3 of the tenets of our Cost of Capital Professional platform that we're going to be talking about today. And as I was preparing today, I went back and looked at an initial presentation that we did when we launched Cost of Capital Professional in January of 2019, and we summarized our goals for the platform as being something based on sound theory and empirical evidence, with simplicity, credibility, transparency, and something that would enhance professional judgment. And I think we're still there today. So we've kind of evolved to straightforward, credible, and cost-effective, but I think we're still transparent, credible, and we've tried to kind of keep the platform intuitive and simple to use, in my terms. We have our agenda on this slide here. We're going to spend the first portion of our discussion just talking about cost of capital theory. We're going to go up to the 10,000 foot level and start there, and then we're going to drill down into how does it work in practice in terms of cost of capital. Then where does the information that is in our platform come from? Where do we get data? So you can know the kind of the transparency part of kind of how it works. And then we're going to end up, but we're going to spend about the last 30 minutes of our time going into the platform itself and doing a demo. We've got kind of a mock company that Adam and I are going to kind of just fill in the fields and let you see how it works for those that haven't spent time in Cost of Capital Professional. There's also information that we'll cover at the end about how you can get a follow-up demo, or and Adam will be available for those types of questions. But with that, I'm going to turn it over to Dr. Mike.
Okay, well, thank you, Ron. What I'm going to do in starting out is have a very high overview, a review of cost of capital theory, and along the way, we're going to mix it in with what's going on with practice. So I'm kind of lead this out and talk about the play-by-play, and Ron's going to come along and be the color commentator. So we'll be doing a little bit of a tag team in this first part. Just in a way of background, what we're talking about in cost of capital is how firms are financed. We have the field of finance. How are firms financed? And once you get into it, it's basically how much does it cost a firm to acquire that finance capital. Firms usually typically get their capital either from equity investors or debt investors. We call them lenders. So they sell shares, sell a piece of the company, and that leads us to cost of equity capital. And then firms acquire capital by borrowing from banks, other kinds of lenders, and that leads us to the study of cost of debt capital. And in the real world, firms finance their companies is in large part by a mix of equity and a mix of debt. Now, overall, the cost of debt is lower than the cost of equity. Why is that? Well, for two main reasons. Lenders are first in line to get paid, so they have lower risk. The lenders have lower risk, so with lower risk, they lend out their debt capital at a lower rate of return, lower interest rate. And the equity investors are last in line. They have a higher risk because they're going to get paid after the lenders get paid. So the equity owners have a higher risk and a higher cost of equity. So debt has a lower cost of capital than equity does because the risk is different. And secondly, in the United States anyway, the tax law says that the interest paid on the debt is tax deductible and lowers taxes, but the dividends paid to shareholders is not deductible and has no effect on the taxes. So the tax benefit associated with debt capital further lowers the cost of debt, at least from the perspective of the firm. Since the firms typically get a mix of debt and equity, it's like mixing bourbon with water. It's going to be weighted. So if you weight it 25% bourbon and 75% water, you're going to get a different mix than if it's 50% bourbon and 50% water. And the same thing applies to mixing equity and debt to finance a firm. And in technical jargon, that is typically called the firm's weighted average cost of capital, or the acronym WACC, often said in practice the WACC. So in finance, it's two sides of the coin. On one side of the coin, we have the capital providers, and on the other side of the coin, we have the capital users. We have the providers having the capital, and they want to get a rate of return on it somewhere. And then we have the firms who need capital to grow, and those are the capital users. So capital providers are the investors, capital users are the firms, and we also have governmental entities as capital users too, selling like government bonds and so forth. Now, capital providers don't send their capital over to the firm for free. They expect to get something in return. Otherwise, why do it? So investors have an expected rate of return, from the perspective of the investors. On the other hand, what the firm expects to pay to the investors for using their capital is the firm's cost of capital. So two sides of the coin. On one side, we have the investor's expected return, and the other side of the coin is the firm's cost of capital. They're essentially one and the same. So we have two general kinds of investors: lenders and shareholders. Lenders get interest, and shareholders get dividends and capital appreciation. Cost of debt is essentially the interest being paid to the lenders. The dividends and capital appreciation that the shareholders get or hope to get cannot be observed directly, but in a direct, indirect measurement, that's the firm's cost of equity. So, general idea, you have investors, but when we start breaking them down between lenders and shareholders, we start getting into certain terms of art. Let's talk about lenders. So this is the firm's cost of debt. So one side of the coin is the lenders, the other side is the firm's cost of debt. So lenders have capital. They can do multiple things with it. They can invest it in treasury securities and they'll get the risk-free rate of return. Or alternatively, the lenders who have the capital can hope to get something higher than the risk-free rate of return by investing in something other than a risk-free asset. So in terms of loans, in which principal and interest would be expected to be paid back, lenders conceptually get the risk-free rate of return plus something extra by assuming the possibility of default, that the borrower is going to default on that. So lenders get the risk-free rate plus a default spread. That is known as the lending rate or interest rate. And on the other side of the coin, the firm calls this the borrowing rate, the borrowing rate. So in practice, cost of debt, how do we get that? Well, let's assume that the valuation date's today. So you look at borrowing rates today, which are observable, at least in the United States, for the most part, because a lot of the lending information is on the internet and can be accessed that way. In contrast, equity returns, this is for equity investors, they cannot be observed. You cannot look on the internet and see what the rate of return is on equity, at least directly. So cost of debt, borrowing rates are easily observable, at least in the United States, because of the transparency. So since they're observable, what do we do next in practice? Well, if we're valuing a particular company, we have to assess the firm's default risk, the risk that the lenders, let's call it a bank, is not going to be paid principal and interest as promised. So not all firms have the same amount of default risk. So technically speaking, if you're valuing this company and you're determining the cost of debt, you want to assess the default risk. The higher the default risk, the higher the borrowing rate, at least in theory. And conversely, the lower the default risk, the better credit risk a company has, the more preferable interest rate it can get. Now, most people know that there's a grading scale, sort of like at universities, where you have different grades, A, B, C, D, and F, or A plus, A minus, and so on. Credit rating agencies have scales too. Moody's, Standard & Poor's, Fitch. They have AAA, AA, single A, BAA, and so on. Those are generally known. So as a business valuator, if you're assessing a company's today's cost of debt, well, you have to look at market interest rates, market borrowing rates, based upon this particular company's credit risk. If it's a big enough company, a credit rating agency may have already issued the credit rating on this particular company, but that's generally only for bigger companies, public or private, listed or unlisted. But for most business valuators, they cannot have access to credit ratings for small and medium-sized companies. So at least technically speaking, you do your own credit analysis or come up with a general idea as to the degree of default risk. So once a evaluator knows that, they can oftentimes go out on the internet and find the lending rates Uh, so in practice, you can, what I understand a lot of practitioners are doing is they're assuming that a typical closely held company has a default risk equivalent to the Moody's rating of BAA, and then the evaluator can go out onto the Federal Reserve's website, FRED, and look up the yields as of any date today or any date in the past, at least the foreseeable past, and look up the yields for BAA corporate bonds. And many practitioners infer that's the borrowing rate for the particular company they're valuing as of the valuation date. Ron, let me ask you, what do you use in practice in determining a particular company's borrowing rate to determine cost of debt?
Thanks for that question, Mike. First, as we continue to do business appraisal over the last several years, we've evolved to using weighted average cost of capital more in our analytical process when we're using an income method to develop a WACC rate and then apply it to invested capital as opposed to an equity rate applied to equity. But when we do that, we have to go through the steps that Mike's outlined to figure out what the cost of debt is for a particular target. And I find, generally speaking, it's easier with larger entities because their capital structure is typically, not always, but typically sorted out, better defined. You can study the right side of the balance sheet and kind of look at the interest-bearing debt and see, how it's being renewed and what the terms are, and you can pull your debt cost, from the enterprise's capitalization structure. We also get challenged though because in smaller entities, oftentimes it's a little messy in terms of, loans haven't been shareholder loans haven't been properly documented. Maybe they haven't been kept current. We're not quite sure what the interest rate is that's accruing. And then on top of that, just to add a little extra flavor to this, if you have fixed amount of debt that's straightforward from that debt instrument, that makes it easy. But if you have a variable, prime plus 2, and you've got a lot of volatility in the markets, and you're trying to figure out what that cost of debt is, over time that cost of debt can change as the market rates change, if the instruments are subject to those market rate changes, or if they're short term and they need to be rolled over and renewed at new rates. But so, I guess I don't know if that's a good answer to the question, but we're using WACC more and we're having to kind of get under the covers and figure out what that cost of debt is. And we typically start by saying, what can we draw from the capital structure of the target itself to try to define what that cost of debt should be.
Okay, well, thanks, Ron. Let me ask the attendees to tell us how they go out and they determine quantitatively the cost of debt. Do they go out to the Federal Reserve FRED website, or are they doing something else? And attendees can type it in to the Q&A tab over in the chat function, and the presenters here will be able to see that. So go ahead and just type that in if you want to tell us how you go out and quantify a company's borrowing rate, whether it's 5.3% or 4.7% or what have you. Now, as you do that, I want to note that you do not get a company's cost of debt by looking at its income statements. The wrong way to determine a company's current cost of debt is not by looking at the interest expense on the income statement and dividing it into, whatever the debt is on the balance sheet in some form, or reading the notes to the financial statement. Why is that? Because for most companies, the loans that were required were not today, which is the valuation date, but some date in the past. And things may have changed either in the capital markets or with the company when that original loan or loans were taken out. So historical rates of return for or borrowing rates are not necessarily relevant to today's. So go ahead and type the Q&As in there on what you were doing. Looking at John, the Federal Reserve data, which I think we're seeing on the screen. Aaron, Fred, BAA, which we're seeing on the screen, plus a rate similar to the company's specific risk premium. So he may be taking what we see on the screen in BAA and adding or subtracting for that. Some
Like
other
just
ones. Go ahead.
I was just going to clarify a little bit that FRED stands for Federal Reserve Economic Data. And if you go to federalreserve.gov, you get to their website that's pretty busy, but there's a tab at the top called Data. And then if you go into that Data tab, there's interest rates as a kind of a sub tab, and you can get the historical rates from 30-day Treasury bills to 30-year T-notes. So that's just under the FRED data, and it's maintained by the St. Louis branch of the Federal Reserve Bank, are kind of the keepers of the rates, and it's all free access. So you might want to go to federalreserve.gov and kind of explore around a little bit.
Okay, great. I will also add that if you're in a bit larger firm, you may subscribe to financial data such as Standard & Poor's Capital IQ database, and they will have different kinds of lending rates based upon credit quality, at AAA, AA, so on, and also the term of the loan, whether it's a 1-year loan, 5-year, 10-year, or what have you. But that requires some money, subscription, and many of the firms don't subscribe to that because of the cost. All right, well, let's push on. So that was cost of debt in theory and cost of debt in practice. So let's move over to cost of equity. So the shareholders expect, remember, shareholders have some money and they want a rate of return. One option for them is to just send their money over and buy a risk-free asset. They get a risk-free rate of return, or they can hope to get more by investing in risky stocks. So conceptually, what shareholders expect by sending their capital over to the firm, buying equity, is the risk-free rate of return plus a premium for holding that risky stock. Now, here's the key feature, and it differs from the cost of debt with the lending rates. Expected equity returns of shareholders cannot be observed. Lending rates can be observed. We saw that as an example on the FRED website in that previous slide, but I can't go out on the internet and show you anything of expected equity rates of returns for shareholders. They cannot be observed. So what do you do? If you can't observe something, but you know it exists, what do you do? Well, conceptually, you build a model trying to estimate, trying to get to some reasonable model of what the real world looks like. So you use models, and models to estimate cost of equity capital include the cost of a capital asset pricing model, or CAPM, and there's some variants of that, or the buildup model. So in business valuation practice, at least in the United States, you often see valuators using the CAPM or a variant or the buildup model. And sometimes valuation folks use both. Depends on their project, I think. Okay, so let's pause for a second. We've covered cost of debt and cost of equity. I want to reemphasize some points here. Cost of debt, mainly in practice for you valuators, mainly it comes from observations. you can observe lending rates. Cost of equity, there's nowhere for you to go to observe it directly. So you must use a model. And in practice, you have to know what kinds of models are available to you. And then you have to choose as a professional which model is appropriate for the particular project that you're working on. Lenders expect for giving up their capital to get a risk-free rate plus a default spread above the risk-free asset. Shareholders expect as their return to get the risk-free rate plus a premium for holding risky stocks instead of a risk-free asset. Okay, if you think of it in these terms, the complexities of cost of capital get a whole lot easier if you just anchor everything here. Okay, so cost of equity. Now, in the nomenclature of the textbooks, sometimes you see it abbreviated. Cost of equity is R sub E, or sometimes K sub E. The K is sort of a term for cost of capital, and R is the return. That's two sides of the coin, same coin. So return on equity, this is just more of a technical specification. There's a risk-free rate plus a risk premium for holding the stock. And in practice, many hours are spent in estimating that risk premium. Many hours are spent estimating that risk premium. This is for cost of equity. And that's where you get into a lot of the disagreements and the debate of how best to go about it. So in CAPM, I want to put this in a little bit of mathematics terms to kind of reduce all these words and concepts into something more concise. So on the top, this is the CAPM, the succinct specification. The return on equity on firm I is the risk-free rate plus the product of the average risk premium, that word average is in quotes, times the beta for firm I. So that premium is the average premium from some benchmark of risky assets multiplied by some coefficient of the particular firm. So if the firm is identical to the average risky assets, then the beta is 1. If the firm is twice as risky as the average risky asset, then the beta for firm I is 2. So it would be 2 times the average risk premium, and so on. And that's what the CAPM is. The build-up model, oh, by the way, that average risk premium you see at the top, in practice, in business valuation, that's the equity risk premium. Okay, let's move on to the build-up model. Expected return for firm I is the risk-free rate. This is the general specification, plus the average risk premium, or risk premium in practice, plus 1 or more risk premiums added to that. And whatever risk premiums are added to the average risk premium is really up to common practice or the valuator's professional judgment. There's no law of physics that says that risk premium 1, 2, and 3, and so on must be certain things. So that's more of a professional decision. Ron, you have done very, very recently a paper on the build-up model. Do you have any comments on what we're saying?
Yeah, I was actually going to interject in the ancillary materials for the attendees today. There is an article that I have put together called "Evolution of the Bum." So, pardon me for the title, but I thought it was catchy. So, but it talks about just my experience in estimating cost of capital from the early 1980s when I first started working at a law firm that had to, that they did a lot of bank acquisition stuff. And I was involved in doing projections of how the bank would maintain its capital structure that involved some cost of capital kind of mechanics. Started my own practice in 1988, doing valuation. Now I do it pretty much full time, and it's just my kind of what I've learned along the way of how the build up method has evolved from when I first started doing this. And I would encourage folks to take it down and read it. I welcome your input and comments. It's 22 pages. It talks about all the analytical procedures that we use to come up with our build up components, because as you drill down into the RP1, RP2, RP, to figure out what is going to be in your model, there's a lot of debate about how you make those choices, and you have to exercise professional judgment. So that article, I think, does a good job of kind of expanding on the build-up model, which we use almost exclusively in our practice. We play around with CAPM, but we're usually valuing small and mid-sized companies where our audience, the divorce attorneys and judges, the trying to explain cost of capital is difficult enough as it is, but when you start talking about beta coefficients and where you get it and how you unlever, relever, and everything else, it's just, we kind of stay away from it. But it's important theory to understand. It actually, if I'm not mistaken, it won a Nobel Prize back in, I can't remember when. You might know, Mike, but the CAPM theory. So it's really the kind of the foundation that actually supports what we do with the build-up model.
Yeah, and just to add to what Ron said is CAPM is generally used by consultants and valuators and equity analysts in valuing bigger firms. Now, I don't know the cutoff for bigger firms, but they expect and investors expect to see CAPM. That's a generalization. For smaller firms, you tend in practice not to see CAPM. Why is that? Because it's really hard to estimate the beta of a small firm. There's a lot of differences that cannot be directly observed because smaller firms are not traded to quantify a smaller firm's beta, and using a bigger firm's beta as a proxy for a smaller firm. Well, you can make that inference, but whether it's a leap of faith is sort of questionable. So generally, since we have that problem with beta and even trying to explain it to users, judges, juries, even to a small business owner or investor, try to explain a beta to them. It's not something that's easily explained. So let's get rid of beta, right? And find a model where it doesn't have it. And that leads us to the build-up model. That's kind of my perspective succinctly. So cost of equity capital, depending upon the model that you may be using, CAPM, a variant of CAPM, build-up model, maybe even another model. By the way, there are other models out there. FAMA, three-factor model, arbitrage pricing model. Usually don't see them in business valuation practice, but there are other models other than CAPM and build-up. So variables that you will see in cost of equity capital models include the risk-free rate, that average risk premium, which in practice is typically named equity risk premium, CAPM beta, industry risk premium, size premium, and company risk premium, which is sometimes called the unsystematic risk premium. So these are common variables in cost of equity capital models that you see in practice. Now, a key feature here, we're not going to spend time here, but it's always been a bit of a challenge, is if you're going to use each whatever variables you use off of this list or any list that you have to avoid double counting the risk. So if using the industry risk premium in your model and a CAPM beta in your model, well, are you double counting risk? You may be. So the general idea is not throw in variables without thinking too much about them, but to make sure that the variables don't overlap, and if they do overlap, accounting for the overlap. Now, all of that's well and good, and this is what I have said in classes to both academic and in practice. This kind of like grounds you in the theory. Now, when you go to a professional conference and maybe you hear something like this, and the theory sounds pretty clean. Here's the CAPM and blah, 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 blah. Here's where you get it. You go over to this great website to get your cost of capital data. But as soon as you get up out of that session, you go out in the hall or around the bar or in the reception, so forth. Then all of a sudden you shift over to the right-hand side. And you have people doing different things, and it gets messy. So I can tell you the theory, I can tell you how generally things happen, but in practice, you have to make your own decisions about what's best for you. Don't look for an accounting standard setter like the FASB or the IRS for giving you tax regs or tax laws in Congress and all that. There is no standard setter in business valuation. The market dictates things. And that's why you end up in business valuation practice, things looking like it is on the right-hand side. Now, as Ron said at the very beginning, the cost of capital platform that we have here, and I'm the author there, and I designed it in a certain way. And one key way is to make it straightforward, because making it complicated and making it and over engineering it, it just is not helpful to you guys as practitioners. What I did not want to do is to create a cost of capital platform that is a Rube Goldberg contraption. And for the younger folks here on the web seminar, if you don't know who Rube Goldberg is, look him up. He's up on Wikipedia. He's a guy that lived several decades ago, and he would make cartoons. He's an engineer as well as a cartoonist. He would draw contraptions, gadgets that did simple tasks, but make them very complicated, and they were quite entertaining. So when I designed the cost of capital professional with the help of BVR to do the engineering and all the hard stuff on the back end, I did not want to make a Rube Goldberg. And that's the first attribute that Ron mentioned as being straightforward. So in understanding value can be reduced to, this is a very simple reduction into a firm's income divided by the risk minus the growth. And that's the dividend discount model, if you don't know what it is. And then more technically, what you see at the bottom, the value of a firm is its free cash flow divided by its cost of capital minus its growth in the free cash flows. Okay, all that's well and good. It sounds very simple, and in theory it is, but in practice, getting the inputs for this clean looking formula, that's the hard part, and that's where you are for practice. Ron, any thoughts?
Mike, I just mentioned that this is a schematic that I've used a few times in testimony, where I have to explain the income approach to value to a judge or a jury. And all we're talking about today essentially is the R of I divided by R minus G. And the devil's in the details. We could have a whole part two to this and talk about how you define the free cash flow or the income part of this formula. But this is just kind of something to help articulate and explain cost of capital and how it works in calculating value to folks that aren't as deep into it as our listeners are today.
So in reality, when you have something that's complex, often the best answer to a complex phenomena is the simplest answer. And conceptually, that's called Occam's razor. Occam's razor, and you may remember that from somewhere in your past. And it's also called the principle of parsimony. So in what I tried to design here on Cost of Capital Professional is try to reduce things to be relatively simple. Now, it's not simple, but it's relatively simple. Making things more complex is not necessarily the answer. It might be the answer in physics when you try to launch a rocket from Florida and you have to get into precisely hit orbit in Jupiter 8 years later. That's governed by the laws of physics, and maybe that is rocket science, literally. But when you talk about cost of equity and cost of debt and so forth, there is no laws of physics. So try to make it simpler. And if you are doing cost of capital and you're taking it out to 5 decimal places, it appears to be scientific, but really it's probably creating more noise than's justified and is distracting. And although it gives the illusion of precision, it's not. It's probably not more precise by trying to make it go out to X number of decimal points. So in cost of equity practice, oftentimes you go leave that conference room and you talk to the people at the reception and so forth, and or you go down the hall in your office and you say, well, what is it? Which number do I use that's in this cost of capital platform or in this book or over here or over there? Which one do I use? And that's kind of like the illustration you see at the bottom. And effectively where it leads you is, is it this number or is it that number? And oftentimes the numbers aren't that different. They're not relatively different. And quite frankly, we don't know which one's the most precise because they're not governed by the laws of physics. So don't get yourself in these positions. These are cost of capital or estimates. They're not calculations for an ACT exam of how you get from point A to point B.
So Mike, that comment, if I can interrupt for a second, that comment reminds me of Jim Hitchner, who I consider one of my mentors, has done a lot of authoring and writing on cost of capital. It's covered in depth in Financial Valuation Applications and Model that I'm a co-author of. But he did a study a few years ago calculating cost of capital using 6 or 7 or 8 different models to come up with a cost of capital. He had a kind of a data set that he used. And my recollection is in the end, you know, the 6 or 7 different models all came within 100 basis points, maybe 150 basis points of each other. It was like, 21% to 22.5% using 6 different ways to calculate cost of capital. So, and 100 basis points can be significant when you're applying it to big numbers. But the learning point is, there's a lot of professional judgment that goes into this, especially on the unsystematic part. And while I'm thinking about it, a couple slides back, we talked about unsystematic risk being the specific company risk. If you're not relying on some of the emerging industry data, for industry risk that is, I'll just use air quotes, empirically measured industry risk, that becomes unsystematic risk as well. It requires the application of professional judgment after a thorough analysis of all the relevant facts. So that unsystematic risk can also be part of the in a traditional build-up model. So I kind of expand on that a little bit in my article. So if that confused you, maybe that will either confuse you further or clarify it as you read that.
Okay, thanks, Ron. And just to emphasize a bit more on professional judgment, some people in business valuation have tried to throw in more and more variables or try to get more and more decimal points in there, trying to remove the professional judgment because they think it's more defensible. Quite frankly, we're in a professional activity. Business valuation is a professional activity like medicine and law and practice of accounting. And you cannot remove significant doses of professional judgment, so why try? If you try to remove that professional judgment, you end up like that guy down at the bottom on the right-hand side, sweating over things that shouldn't be sweated about. So with all of those variables in the cost of capital that we just saw a moment ago, those variables are available in the cost of capital professional, and then they're sort of in the back end library, so to speak, of our platform, and then you can draw it out through a user interface to put together cost of equity capital for the company that you're valuing, and weighted average cost of capital too. Some of that information is in the library that you pull out as a user, and some of it you have to input yourself. So sources of the variables in the platform: risk-free rates data comes from the Federal Reserve. Equity risk premium comes from the Center for Research in Security Prices, known as CRISP. That's from the University of Chicago. Dr. Aswath de Motorin's data library. The size premium data comes from CRISP. Industry risk premium comes from Dr. de Motorin's data library, and also publications from Salvideo and Partners, which is an analyst firm in Italy. And then for CAPM beta comes from Dr. de Motorin's data library and Salvideo and Partners again. So these are data sources for most of the data inputs that you need for cost of capital. Let's dive in and look at some of these individual variables and what it looks like, and some of the nuances that we have for risk-free rates. Often in practice, we think of the United States Treasury securities as risk-free assets. They're the closest things to being free from default risk. And that data is available. The yield data is available because Treasury securities are actively traded. So from the Federal Reserve website, FRED, we can get the yields on, I'm focusing here on T-bonds, Treasury bonds. And in practice, some practitioners, particularly ones doing the larger firms, like to use the 10-year bond, 10-year government bond. For historical reasons, business valuators in the United States have gravitated to 20-year government bonds. The debate of which one you use is trivial. That debate is trivial because if you look at the yields differences between the 10-year government bond and the 20-year government bond, they're not that significant. So if you want to argue about 10-year T-bonds or 20-year T-bonds, it's more of how many angels should be dancing on the head of a pin. It's not really all that significant in reality. Sometimes you'll see the risk-free rates as being T-bills rather than T-bonds. The theory behind that is whatever you're valuing. If you're valuing traded stocks and you're a trader, your holding period is relatively short. That's your investment duration, and go with the shorter duration treasury securities, T-bonds, T-bills rather. For buying a business or an interest in a business, the expected duration of the investor holding period is longer, and that's where you go to treasury bonds as being the risk-free asset to match up for your model for the risk-free rate. Equity risk premium. I'm going to focus in on three general kinds of equity risk premiums, or ways to develop it. First is the historical method. Second is the forward-looking method. And the third is the macroeconomic regression model method. So the first one is generally known as the historical equity risk premium. The second is generally known as the implied equity risk premium. And the third is generally known as the supply side equity risk premium. These are three common ways in business valuation practice to estimate a particular equity risk premium. For the historical method, go back in time, observe the returns of risk-free assets, and for the same time periods, the returns of risky stocks, and calculate the difference in returns between the risk-free asset and the risky stock. And that difference is calculated on each time period, and then get the average difference. And then that becomes the historical equity risk premium. In practice, you have to get a proxy for risky stocks. And in practice, at least in the United States and in many other countries, it's often the proxy for risky stocks is the S&P 500. For other countries, such as in Europe, they may get another benchmark, such as the England's FTSE, which is their big stocks in England, or the DAX, which is the big stock index in Germany, and so forth. So some proxy for risky stocks, and then subtract it from the risk-free rate, and then get your proxy for whatever risk-free asset you want. The United States, again, generally the proxies are the returns of the S&P 500 and the returns of the treasury securities. Get the delta, get the difference between the two, average the difference over the years. That's the general methodology. Now, looking at the historical time period is a crucial variable. It's a decision that you have to make as a practitioner, because if you look at different time periods, you get difference between returns of stocks and risk-free assets. And I'm going to show you that in a moment. So that's the historical equity risk premium. The forward-looking method, the implied equity risk premium, uses the current stock prices. So whatever the current market is, rather than going back in history and looking at historical stock prices, and puts it into a financial model. The implied equity risk premium is a model that is supposed to be forward-looking as of today, or whatever your valuation date is, rather than what happened in the past, such as recessions, depressions, world wars, and so forth. The third method is a macroeconomic model, is the basis. That is common practice. Supply side equity risk premium, that uses a regression model trying to predict the stock returns, and the explanatory variables, the dependent, the independent variables are macroeconomic variables. Thing is there's no law of physics of what those variables are. So pick your poison, what your macroeconomic variables are in your regression. So for the equity risk premium, we have the historical difference between the returns of risky stocks and the risk-free assets. Let's take a look at this. So this is using a 20-year T-bond, and it's going back in time to look at the stock market and the T-bond returns back to 1926. Back to 1926. So that's 98 years. It's almost 100 years. And what you see, take a look at, well, first of all, one of these lines is the arithmetic average, and the other one's geometric. We don't have time to get into the distinction with that. But just take a look from year to year. They just don't change that much from year to year. And there's a mathematical reason for that. So here we have about 100 years of data in which we're deriving the historical equity risk premium. I want to try to explain to you the mathematical properties of why it just doesn't change that much from year to year. And it's almost a flat line because of the mathematical properties. Let's suppose that you go to a conference and you're in a large meeting room and there's 100 people in that meeting room. I'm going to come into the 100 people and look at how tall each person is and get the average height of those 100 people in there. And I can do that for 100 people. Now suppose there's one more person coming into the room. So now we'll have 101 people coming into the room. And suppose that one person coming into the room is a giant or a dwarf. What kind of effect does the 101st person have on the average height developed from the 100 people? The one new person does not change the average height in that room. And that's what you're seeing here, is that when the sample size gets big, here it's about 100 years, one more year of data just doesn't change that average very much. So as we move along in years, this historical equity risk premium is almost a flat line. So depending on which one you want to use, it's going to be 6% a year, plus or minus a little bit, or 4.5% or 5% a year, plus or minus a little bit, forever from this point forward, just because the averages are really, really big. Here it's 100 years. So that's just a mathematical property. That's a disadvantage of the historical equity risk premium, because are stocks riskier in one year versus another year? I think they are, but mathematically, the historical equity risk premium method just doesn't capture how risky stocks vary from year to year. Now let's look at the historical equity risk premium in comparison to the risk-free rate. At the top is the risk-free rate. You can see that can get volatile over time, but the historical equity risk premium, which you see in the bottom plot, just doesn't change that much over time. So as the economy changes over time, the risk-free rate adjusts up or down, but the equity risk premium doesn't change that much over time. And intuitively, that just doesn't seem right. I think risk changes over time for whatever reason, wars or depressions or great recessions or what have you. We know those things occur, but the historical equity risk premium, based upon mathematical properties, just doesn't change that much, and that does not seem intuitively right. The same thing occurred in the as an example in the pandemic in the March and April of 2020. We know that the stocks got risky and the prices fell, and so did the private companies. The market froze up too, but the historical equity risk premium at that point in time just didn't change, although risk-free rates changed, and intuitively we know risk changed at that time. Ron, did you have anything?
No, I will mention, though, that we've got several questions that people have been submitting, and I've been kind of monitoring those, and we're going to try to leave some time at the end to address at least some of the questions, and we may actually use some of the points and questions and comments to potentially develop a part two to what we're presenting here today. So bear with us, because I'm looking at those questions as Mike's kind of carrying most of the weight here at this point.
Okay, well, thanks, Ron. And hopefully those questions don't show us that we got some people online that are the guy in the plot that was sweating.
No, but one of the questions. Let's just deal with one of them that I'm looking at here. Should you consider a normalized risk-free rate when doing a valuation at a point in time when market conditions might not be considered normal, i.e. during COVID rates may have been lower than normal? So that's the concept of using a conditional or normalized risk-free rate as opposed to pegging it to a 10-year or 20-year T-bond.
Well, my question is who's going to be doing the normalizing, and what methodology do they use for normalizing, and what's the qualifications for normalizing? So in academic research, there's no such thing as normalizing. So it's kind of like the government's going to tell us what the thing to do here. So that's kind of like, well, who's doing the normalizing, and normal compared to what? That's kind of my reaction.
Yeah, we've stuck with using the rate that we get from the Federal Reserve Bank, and when we're in a period where we had quantitative easing and the artificially low rates because of government intervention, there was a notion that we need to make that up somewhere, but we in our shop made it up in the unsystematic risk adjustment, as opposed to trying to work with some somebody's judgment on what a normal risk-free rate should be at a particular point in time. Well, and one other question I'll just say one other question we have here. Go ahead, Mike.
Yeah, Ron. Do you remember what year the idea of normalizing the risk-free rate came about, and how long that idea has been here where things haven't been normal? 2008. Yeah. So we're coming up on 20 years of being non-normal. I wonder when the present becomes the new normal.
Yeah, I could go off on a tangent on this. I know a lot of people that aren't as old as we are keep waiting for mortgage rates and car loan rates to go back to what they thought were normal over the last 10, 15 years. But in my world, I think we're back to what's a normal, mortgage rate. So it's all perspective. One of the other questions is, can you address the argument that there is no small stock premium? We will get to that, and Adam and I, when we go into the demo, we're gonna show you how, if you change the horizon for what you pull from the CRISP data, how that adjusts the size premium. So we'll show you how that works in the platform itself as well.
All right, well, let's push on. So we have been talking about the historical equity risk premium. Now let's push on to that second way of estimating equity risk premium, the implied equity risk premium. So this uses current stock prices, and the idea is that whatever people are buying, the prices that people are buying their stocks and so forth, they're anticipating the future in their buying actions today. So it's believed that the current stock prices represents forward-looking expectations. And the argument for using the implied equity risk premium is it takes into account conditions that exist today, and rather than conditions that existed over the last 100 years or whatever. Because today, we know intuitively conditions change over time, and the forward-looking equity risk premium considers that, because as as risks go up or risks go down, or the economic conditions become more favorable or less favorable, they show up in today's stock prices, and the implied equity risk premium uses current stock prices and therefore uses the current conditions rather than historical conditions. That's the argument for using implied equity risk premium. How that's developed and the arguments for that are quite in depth. And at the bottom of this slide, I've given you a paper from Dr. Damodaran to be able to read about that. And this is actually a pretty good paper to read. He puts it out every year. He updates it every year. And it's over 100 pages. So you're not going to read it in one sitting. But if you want to learn more about the equity risk premium, and he covers it all without having an agenda, this is a really good paper for you to read and study. Now let's take a look at, so we saw a moment ago that the risk-free rate bounces up or down as economic conditions change up or down. Let's look at how the implied equity risk premium is developed by Dr. Damodaran. He measures that, makes it freely available. On this slide, the heavy line, the red line, is the equity risk premium. You can kind of see that there's some volatility there, as well as the volatility in the dotted line, which is the 20-year T-bond yield. So as economic conditions change, favorably or unfavorably, you would expect investors and prices, security prices, to change. And indeed, you see it in the risk-free rate, the dotted line. You also see expected volatility in the implied equity risk premium. But as I showed you before, on the bottom slide here in the historical equity risk premium, it's nearly a flat line because of mathematical properties. So this maybe convince you that implied equity risk premium takes into account the present day economic conditions rather than what they've been over the last X number of years. On the supply side equity risk premium, as I said, this comes from a macroeconomic model. It uses a regression model. Remember from your statistics class, well, not everybody took statistics class, but you have y equals x1 plus x2 plus x3. And those x's are the explanatory variables. And the what's behind the supply side equity risk premium is a complex macroeconomic variable. It's documented in a paper that's now 20 years old by Ibbotson and Chen. And one thing that if you actually go read the papers, they don't say that there's only one set of macroeconomic variables. It can be different sets of macroeconomic variables. And all of these are macroeconomic variables are being used to try to predict through a regression model what the stock market's going to be doing. So it becomes somewhat complex because it's regression with many explanatory variables, but it's also even more complex because which macroeconomic variables do you use? And there's no bright line between what's right and what's wrong in selecting explanatory variables. Which equity risk premium is better? Which method is better? Interestingly, Dr. Damodaran came up and did a correlation analysis between predictors. So over on the left-hand side, you see different ways people are trying to predict returns of the stock market. And this is short-term stock market returns and longer-term stock market returns. So earnings yields on the left-hand side, dividend yields, current and implied premium, average implied premium last 5 years, historical premium, and then the default spread based premium. All of these are kind of ways that people are trying to predict stock market returns. And then in the columns over to the right, you see the measures for short-term excess returns in the stock market, longer terms at 5 years, and 10-year returns. So what Dr. DeMotorin did here was he did correlation analysis to see which predictor best predicted the stock market returns above the risk-free rate in the future. And I want to concentrate my discussion here on 5 years in the future and 10 years in the future, which would be a more long term. So if you take a look toward the bottom, the historical premium does not predict the excess returns of the stock market in the distant future. In fact, it's a negative correlation, which means that it has the reverse of what's desired. And in actuality, the implied premium, or using the an average of the last 5 years of implied premiums, has a positive correlation in predicting longer term stock market returns above the risk-free assets. So what this is kind of like getting into the weeds. This is actually a test of which method of estimating stock returns or excess returns, equity risk premiums, actually proves to be better in the real world using real world data. And if we're looking at longer terms, 5 and 10 years, it's the implied equity risk premium, and the historical equity risk premium actually has a negative. So this is where you get into theory and practice. In practice, the data says implied equity risk premium is a better predictor, much better predictor than the historical premium. Okay, and I know we're getting short on time, so I'm just going to push through here. Changing the time periods in if you're going with a historical equity risk premium changes your answer. So if you look back to the earliest parts in the American data set to get the historical equity risk premiums using T-bonds, going back to the 1920s, you get 6.8%. If you look at the last 50 years, from 1974, you get 5.95. That's almost 1% difference. And if you look at the last 10 years, you're up at 11%. Point being here is whatever you decide to use in using historical averages, you explicitly or implicitly make an assumption of how far back in history to use. And whatever you decide, explicitly or implicitly, for the number of years in your look back, you're likely changing the result of whatever you're trying to determine. So this is how it changes. The look back period changes in the historical equity risk premium. This is how it changes for the size premium. So over on the right-hand side in the box, you see how the size premiums change from decade to decade. And just to try to address very briefly about the size premium, if you believe that the size premium is proven by traded stocks, listed stocks, take a look at what's happened in the last several decades. Over the last several decades, overall, there hasn't been a clear positive return from the larger stocks. And that's where you get into, at least from the stock market, the US stock market, the data does not show any statistically significant size premium. Now, that's the traded stocks. If you believe that they exist in private companies, well, that's different. But this is data that's coming from the stock market. So here's the bigger picture. Choice of your time horizon affects the numbers that you use. And the cost of capital professional platform allows users to specify their desired time period. And please don't ask me what's the right time period. I can't tell you. That's something that a professional has to decide on their own. And there's no authority to tell you what the proper time period to use when you're doing look back averaging. Size premium, usually derived from either the difference between return to the small decile firms and big decile firms, the S&P 500. And as I just showed you, the time period that you select matters. Then when you subdivide small decile firms. So in common practice, decile 10 has been deemed to hold the smallest of firms. And then in recent years, people have tried to carve up the 10th decile into deciles A, B, C, D, E, F, G, H, I, or whatever, in smaller and smaller subdeciles. There's some theoretical problems with dividing it up into smaller and smaller and smaller subdeciles. First of all, for the first 35 years or so in the data, there were fewer than 30 firms in decile 10, the smallest decile. It's fewer than 30 firms. So for those years, if you're dividing it up into smaller and smaller, you're getting fewer than 10 firms in each subdecile, and that's getting smaller and smaller samples. Okay, that's the first 35 years in the CRISP database. Then you get into another argument of why don't subdivide decile 10 into smaller and smaller and smaller subdeciles, as before 1972, there were no NASDAQ firms in it. So before 1972, no NASDAQ firms. Since 1972, NASDAQ firms, which tend to be smaller, in reality, you can argue that those are two different populations of firms. And only since 72 do you get really smaller firms that are similar to small and medium-sized companies. That's an argument. Third argument of not subdividing smaller firms, not subdividing that decile 10. The smallest of the smaller firms are small for a reason. So those smaller firms that are in decile 10, they're heavily populated with marginal firms. Small firms that have financial distress risk, lower profitability, lower cash flow, and higher leverage. And I've given you reference to a couple of journal articles that get into those details. At the bottom here, I have a quote. And it's a quote from the current edition of Shannon Pratt's Valuing the Business. The quote is, "Troubled companies make up many of the companies included in 10B, that's subdecile 10B. Their market values are trading as call options, causing the beta measurement problem." So this is essentially saying that when you subdivide decile 10 into smaller groups, you've got some marginal firms in there. And then that relates to, well, are those marginal firms like my firm that I'm valuing? Okay, we're a bit past the intended goal here. So I am going to stop with my part here, and I'm going to turn it over to Adam and Ron to get into what you came to listen for. How do I get the data, and where can I get it, and how easy it is to get?
Thank you, Mike. So now we're going to share our screen and take a look at the platform. Mike, Ron, and I are going to turn our cameras off to hopefully maximize the viewable area here. All right, so hopefully everybody's seen our screen now. So we're going to walk through the cost of capital professional and talk about how you can use the platform to come up with the cost of equity estimate for, in our case today, our hypothetical subject company, which will be a restaurant with about $7 million in market value. The first field here on the input tab is for your company name. So this is an optional field, and this is solely used for the export at the end. So when you've gone through the platform and you've done your estimates, this will be used in the takeaways should you enter it here. BVR is not logging or storing this information, so it's just for your own use. There is a save feature if you want to save your work, which we'll talk about here in a minute. And all that information that you save is encrypted. It's only viewable by you, so that can't be accessed by anyone at BVR, any of our staff, or anyone else. It's solely for your use. All right, so we will go ahead, enter our company's name. In our example here, we're going to go ahead and use a valuation date of December 31st, 2021. And as Mike talked about earlier, you get to measure the measurement period for your returns. So you begin by selecting how far back you wish to begin that measurement period. You can go all the way to the earliest year, which is 1928, or you can choose any year between 1928 and the current year. So you have that flexibility to determine how your returns are measured over that period of years. So we're going to go ahead and select the earliest year here.
Adam, I'll comment on that as well. So our platform goes back to 1928 when Dr. Ibbotson did his thesis on equity risk premiums. He went back to 1926, and as I understand it, he wanted to go back to capture the period before the run up to the Great Depression, and that's why he selected 1926. We've elected to have 1928 be our earliest year because it ties out to a lot of the data that is published by Dr. DeModern to be consistent with his data. But I think what's relevant here is, as Mike said, if that one more person walked into the room or 2 more years walked into the room, 26 and 27, it wouldn't move the needle much when you're going back to either 1928 or 26. But we're also, time permitting, once we get through our sample with our restaurant, we're going to go back and show you how the data calculates differently if we use a 1972 or 1963 or a 20-year horizon. So we'll show you how the platform is very responsive to you having the flexibility to determine kind of the horizon that you want to use.
Excellent. Thank you, Ron. And for the end of your measurement period, when you do select a December 31st date, you have the option of using the end of that year or the year prior. So you can go ahead and make your selection there. And for the calculation of your averages, you have the option of using arithmetic or geometric, depending on which you prefer. Once you make your selections on the input tab, you have some tabs that appear at the bottom here. So for the risk-free rate tab, you have the option of using either the spot rate for the 10-year T-bond or the 20-year T-bond, or you have this third option here where you can enter your own risk-free rate. So if you wish to use something other than the spot rate for the 10 or 20-year T-bond, you have that option. Once you select it, you'll also see that there's a note box here. As you go through the platform, you'll see there are various areas where you can type in notes. And these are for the report that's generated at the end. Anything you include, next to any of your variables that you input, either manually or select, that gets carried through to the report that gets generated. So if there's anything you want to note or document as you go through and do your cost of equity estimate, you can do so, and it all carries through to the very end. After you make your selection on the risk-free rate tab and you move over to the equity risk premium tab, you have equity risk premiums from 2 different sources, CRISP and Dr. DeModern, which Mike was referring to earlier. So you have access to both historical ERPs as well as implied ERPs from Dr. DeModern, as well as his historical ERP. And again, as you saw on the risk-free rate tab, you have the option of entering your own ERP should you choose, and including any sort of notes that would correspond with the selection that you made there.
Adam, can I make a comment here?
Absolutely.
Yeah, take a look at the equity risk premiums that are here. They don't vary that much. Here on this screen, it's 6.01 to as high as 6.87. That's not a big difference, and since it's not the laws of physics, that's a very small range in estimating what you think risky stocks are going to result in. So it's not so much a question about, well, which one do I use? Just be consistent and be able to logically support which one you use.
Good point. And another thing to mention too before we move on is you see how the ERP is calculated. So you have the return for the S&P over your measurement period, as well as the T-bond that you're calculating it from over here. When you move over to the size premium tab, you have the 10 crisp deciles displayed over here on the left, as well as some combined deciles as well. You have the count of firms that are available in each of the deciles, as well as the breakpoints. So the market cap of the low and the high for the firms in that decile. Over here to the right, you have two columns. So you have the size premium calculated as the average annual return of that decile relative to the S&P 500, as well as the beta adjusted size premium, which is the S&P 500 size premium over here on the left, adjusted by that portfolio beta. So after you make your
Adam, let me add a couple things here. And if you have questions over, well, gee, do I use the size premium over the S&P 500 or the beta adjusted? You need to understand the underlying theory, but there's a very robust FAQ section in our platform where you can go and look at some explanations of, you know, the size premium of over the S&P 500 versus beta adjusted, or gee, should I use the arithmetic or should I use the geometric for that selection that you have a choice on that initial entry screen. If you need to be refreshed on kind of what's the difference between arithmetic versus geometric, the FAQs can help you to sort those things out. So, and I'm also going to be respond to one question. Why does Cost of Capital Professional only have data up through 2021? That's over 2 years old. That's just the date that Adam and I selected for this trial, but we have data through 2023 and through the current period. So we're valuing a company as of December 31, 2021 in this example. But if you were valuing a company as of the end of 2023 or even a more current period, it'll pull data for that period.
Yeah,
Yep.
we got the current data, which I think the latest data is through December 31st, 2023.
Yep, exactly correct, as well as any sort of current spot rate for the T-bond you would have, if your valuation date was in 2024. And also to mention too, you can use valuation dates all the way back to 1980. So if you have a valuation, that has a date from several years prior to today's date, you have the ability to go back and, input anything between today, in 1980, for your valuation dates. If you're using the build-up method and you want to include an industry risk premium, there's a tab here where you can do so. If you are using the build-up method and you want to skip using an IRP, you can do so as well. But if you visit this tab here, you have two sources for levered industry betas. You have levered industry betas from Salvideo and Partners, as well as those from Dr. DeMotorin. Some people ask, what are the difference between the two resources that are in the platform? Salvideo and Partners, they use GICS for their industry classification of their industry betas. Dr. DeMotorin has his own industry classifications. If you select Salvideo and Partners, which we'll do in our example, you have the option of using either a 2 or 5 year beta, whereas Dr. DeMotorin, I believe, does a weighting where I think he weights 2/3 to the 2 year and then 1/3 to the 5 year. So it's a bit of a hybrid. But both resources that you can utilize, and you can make the decision as to which you prefer to use. If you select, say, Salvideo and Partners, and you wish to include a levered industry beta here for your IRP, you can either look one up using this drop-down menu, so you can scroll and see what's available. Another option you can use is you can search by industry keyword, or you can search by SIC code. So we have them mapped over to SIC. So in our hypothetical restaurant example here, you can begin typing 5812 to see what industries are available for that SIC code. Alternatively, you can begin typing restaurants. And we see here restaurant is included both in the sector name as well as the industry name. So you can either click restaurants here, or if you felt that the industry you were looking at had too few companies and you wanted to move up a level to the sector, you can make that selection as well.
And Adam, just to emphasize a point here, you have these two sources for your industry risk premia, but you're not obligated to use one or the other. Oftentimes in our practice, we'll go in and we'll look around in Cell Video and with Dr. Demadrian's industry data, but then we'll use that as part of our overall analytical process to come up with what we want to add as unsystematic risk for the industry risk. So, because oftentimes when you drill down to the 4-digit SIC codes, the number of, we have here restaurants, 26 firms, gives the numbers that come from Cell Video. But if you don't want to bank on that, you can just say, well, at least that data tells me that there's a little extra risk, and then I can just use that as one of the inputs for the subjective determination in an overall unsystematic risk adjustment.
Absolutely. So, if you choose, you can, enter your own custom industry risk premium down here in this box. So as you saw on the prior tabs, you have the flexibility to enter, any sort of input that you deem relevant, either based on your analysis, within the platform or outside, and then include any additional notes to accompany that decision. So here we're going to go ahead and select the 5-year industry beta, and then our IRP is calculated down here at the bottom. So on the next tab here, you can determine which cost of equity model you're going to use within this platform. So you have the build-up model up here, you've got CAPM below, and then you have your risk-free rate that you selected on your first tab carried over. Your ERP is carried over as well. Your size premium that you've selected has been brought over. And here you have the option of using either the S&P or the beta adjusted size premium. Here is our industry risk premium that was calculated on the IRP tab. So we can use this in conjunction with a company specific risk premium, or we can use an unsystematic risk premium that's going to incorporate elements of both. Should you not want to use the IRP that we calculated. Here you also have the option of including any notes associated with your decisions that will be carried over into the export that you generate here at the end. And if you wish to be done here, you can jump over to the summary, you can download your work, but if you wish to do a weighted average cost of capital calculation within the platform, you can do so on the next tab. So you can begin by entering the equity percentage of your subject company, or the equity percentage that you wish to use. Once you do that, your debt percentage will be calculated below. And then you have the option of including your borrowing rate as well as your tax rate over here. So we'll go ahead and use 6% and include something for our tax rate. And again, any notes you wish to include, they'll move over to the report that gets generated. All right, so now that you've gone through and you've populated those fields, you have this text that's generated here on the final tab. So this documents all the inputs that you selected. It provides all the sources that were used for those inputs. It shows the calculations that you used for your cost of equity estimate, as well as your weighted average cost of capital calculation, if you did that. And you have this copy button over here. So what this allows you to do is copy everything that's included here on this tab to paste into Microsoft Word or the report that you're working in, and it will generate this text with all this formatting. So we'll include all the line breaks and all the bolding and underlines that are included here. But you also have the option of downloading this information to Excel. So back up top towards the user input tab, you have the download option. You can download this document, open it up. All right, so in the Excel export that's produced, you'll see there are 3 worksheets here at the bottom. I'll zoom in a little bit, so hopefully it's easier to see. The first worksheet here has your user inputs. So this has all the inputs that we had specified on that input tab. And as Ron and Mike noted, you can use the valuation date with data all the way up until today. You can go back to 1980 if you have an older valuation date. You choose the measurement period for your returns. You can go all the way back to 1928, or you can specify a year that's more current. It's up to you. You also have a couple links here just for your personal, I guess, documentation. So you have a link to the platform, also a link to the FAQ page if you want to go and read any definitions of terms or calculations or frequently asked questions. The next worksheet has your selections and calculations. So everything that you select, cost of equity estimate and your WACC calculation, is documented here. Then that final worksheet, and this should look familiar. So this is the summary that you saw on the platform. So this is also available in Excel, should you not, have copied and pasted it out into Word, or if you just wanted to save it separately for your records and for your work. And go back and take a look at the platform here one more time. So here you have a tab for user references. Here's a quick link to the frequently asked questions. So if you want to learn more about the platform or the calculations or the data, this is a really good resource. If you're looking for some short video tutorials, that's an option as well. And these are both available, outside of the platform on the product page. So if you don't have a subscription to the Cost of Capital Professional and you would like to read the FAQ page, you would like to read more about the product, you'd like to watch the video tutorials, you can navigate up here to deal and market data, and then go over to the Cost of Capital Professional. And you will find all of those resources over here. So here's a video tutorial. Here's a prior demo and webinar that we've done. And here's a link to the FAQ page, if you'd like to learn more. And as part of your subscription, you also receive access to quarterly beta reports that are produced by Sell Video and Partners. And those reports provide you with levered and unlevered industry betas. And they're free, with the subscription to the platform. And we don't have this posted yet, but we also have a free rate lookup tool that's available, to anybody with a My BVR account, which we're going to link to here. So if you want to pull in, any sort of, T-bond rate, or if you want to pull in, prime rates as of any date, it basically pulls down that package from the Federal Reserve for you. So that'll be available here soon. And if you wish to save your work, you're in the platform and you want to save what you did for your client, maybe to revisit or modify later, you can do so by clicking the save option. Here, you can go ahead and enter, the name, of either your client or the name of the engagement or anything that you want to be able to use to recall it later, along with any notes. All right, so we'll go ahead, save this. And if you come into the platform in the future and you wish to pull up the work that you've previously done, you can go ahead and find that under the saved screens here. So here's the one we just did. So restaurant, we hit apply. And it brings us back to that cost of equity estimate that we calculated in our example here. So I know that we are hitting basically the end of our time now. I will pass it back over to the slides, and I think we can look at a few different.
Before we go back, Adam, let's just spend a couple minutes. Let's use a 2023 year-end date for our valuation date, but let's select a different reference year. So just to show that we've got data through 2023 for that part, but under the select, and let's do a custom year.
Sure. What would you like to see?
Oh, let's just go back to, let's go to 1980.
All right.
And then, and the reason we have 2023 and 2022 as a choice there is kind of the known and knowable rule. If you're doing a valuation as of 2023, the data that is in CRISP and otherwise might not technically be available as of December 31, 2023. So you have the option to say, I'm going to use the year prior if I'm concerned about getting tripped up on known and knowable. But so you have that choice, that flexibility. But I just wanted to go in and so now it's pulling the data from that shorter horizon. And if we go into the size premium tab and we go down to the 10th decile, you can see now that the size premium is negligible because of the shorter horizon versus the 98 years if you go back to 1928. So if you, and this is pulling data directly from Chris to make these calculations as you make those inputs into the input screen. So if you want to kind of see how the size premium changes with different time horizons, you have complete flexibility to do that. And it also is a good segue to one of the questions. What do you think about preparing multiple scenarios using different component choices to illustrate how the different choices impact a range of cost of capital? Complete flexibility, as Adam showed. You can save your work. You can come up restaurants 1, restaurants 2, restaurants 3, and apply and kind of have several models to say, you know, I've calculated cost of capital different ways with different inputs, and you know, in the end, you know, my cost of capital is, it might just be a number that you call out, you know, as compared to the guy trying to push the red button.
Excellent. All right. Well, thank you. So I know we have a few slides left. I'll pass it back over. So Ron, if you want to take us through the next couple slides, be our guest.
Yeah, absolutely. So here we have just some inputs that are coming from the platform, and these are arithmetic numbers. If you went in and pulled these same date ranges, it has the geometric over here in the parentheses over on the left column. So you can just see the equity risk premium in with the different time horizons in terms of how that changes from the direct data and the De Modern model with the implied returns. So you can just see that the range of the equity risk premiums using those particular horizons. Next, we have, and this kind of emphasizes what we just went in and did a little test on the fly of. If you look at the size premium returns of the 10th decile using different horizons from 1928 to 2020 in this example, we could do it through 2023, but you got to buy a subscription to get the current numbers. But just for sake of example, that long horizon gives you a 7.84 size premium in excess of the S&P 500 returns from 1963, 3.81, and from 1982, 0.71. So you can see as the horizon shrinks, the size premium goes down dramatically. And you got to pick your poison and just understand that, you know, it's not a given that the size premium should be measured over, you know, the longest period that you have available. You can make that argument, but you don't necessarily need to.
Yeah, let me just interject on that. Remember, before 1972, there's no NASDAQ firms in there. So if you want to make a simplifying assumption that NASDAQs have a lot of smaller firms, and the smaller firms are more similar to my small firm that I'm valuing, that's where you get into, well, should I be looking at a more recent time period than going back earlier? Also, just, I know we're short on time, but if you take a look at all the way over on the right hand side, and we didn't get into this, but the big jumps that caused the size premium here, what you see 7.84, the big jumps there occurred in 3 years, in the 1920s, 1930s, I think it was. So the big jumps that resulted in the 7.84 happened in the very early years, but it was like 3 particular years that caused that to go up that much. So if you think the present time looks more similar to the last 40 years or the last 60 years, you can do that. If you want to go back and do the beginning of time when things seem to be very different with smaller firms in this data set, then you've got the choice to be able to go back to the 1920s. Your choice.
And just to emphasize a point that Mike made earlier, this is the calculations of the size premium based on publicly traded securities. It doesn't measure a size premium or adjustment for size for a small, closely held business that is potentially significantly smaller than the average firms that make up the 10th decile in this instance here. We've talked about the 10 decile returns. We don't split the 10th decile into the subcategories for the reasons that Mike articulated, including what's on page 244 of the 6th edition of Valuing a Business. There's also some good arguments in the PPC Guide to Business Valuation in sections 505.32 to 0.36 in terms of why there's issues with dividing the 10th decile into the smaller components. And as I think this is back in Adam's court, that you can go to the link here and get direct access to the FAQ information. And I would tell you to explore that because I think it's rather robust and informative in the video tutorials. So, and with that, I'll turn it back to you, Adam.
Thanks. Thank you very much. So the other thing that I'd like to note as well, so we looked at the cost of capital professional page. But one thing we didn't touch on there was that if you would like a demo, you can sign up and you can receive a free personalized demo, but also you can receive a free trial. So if you'd like access to the platform for a week or two, you can go ahead and sign up. And we'll get in contact with you and we'll get you access and you can take a look and you can use the platform for yourself. So here's a link. You can also email us, info@bvresources.com, if you'd like to take a look at a 2-week trial. Just also some other bonus materials. We talked about the quarterly beta reports, but annually we also post a key summaries PDF. So if you don't want to use the platform, you just want to use a few, year-end figures, you have access to those, with your subscription. And with that, I know we went a bit over, so thank you so much to everyone who stayed with us. We appreciate your time, and yeah, please reach out to us. We'd love to get you connected with access to the platform and answer any questions that you have. Mike and Ron, did you have anything that you wanted to add in closing?
The only thing I say is thanks for persevering and sticking with us. Cost of capital is a heavy topic. And hopefully you got something out of this to make it less complicated, at least in your world.
I'll add that there's a few questions that we see in the Q&A that we haven't had time to get to, but I think we'll continue to have access to those questions. So don't be surprised if we reach out to some of the folks that have asked us questions to try to be responsive to some of those that we can clarify or expand on.
Well, on behalf of BVR, I want to thank our speakers for an excellent presentation. And I want to thank our listeners for attending and for your thoughtful questions. I think based on your feedback, we'll certainly be considering doing a part 2 to this. As a reminder, to receive CE credit, you must complete and submit a brief survey on this webinar. A link to the survey is provided in your login email and on the reading page for today's webinar. Your feedback is key to providing the best possible programming for you, so please provide us with any suggestions you may have. If you choose to fill out the survey, your browser will automatically direct you to the CE credit page when I finish speaking, so don't disconnect. The survey will be active for 5 days and must be completed before we can process certificates. After 5 business days, we'll process your CE and send your certificates via email. If you have any questions related to the content or format of this webinar, please email me at training@bvresources.com. Coming up for more BVR webinars, we have another one tomorrow, Thursday, April 18th, that Stacy Udell will be presenting top issues impacting cannabis valuations. And next week on April 24th, we have our quarterly series webinar, BV Law Case Update, with Jim Allardine, Andrew Shosnick, and James Ewert. You can find additional offerings on our calendar page as well under live events. Thank you all for listening. Have a great rest of your day. We're going to end this webinar now, so please go ahead and fill out the survey.